Welcome to TheoTrade. This is Don Kaufman. It's October 7th, 2019, and you are watching the TheoTrade evening video. There are just moments left in today's cash session with the S&Ps down about 850. But I got to tell you, we have had quite the wild trading range today, all the way down from 29.28 up to 29.60. I mean, listen, you can't complain about a trading session that's got over a 30-point range inside of the S&Ps. It was chopped out. It was wild. We got tweeted upon multiple times, that is. There was a Chinese tweet, "We loved you." There was another tweet, "Not so much." But the S&Ps are doing, a lot in answering this question. Are we back in the volatility box? Let me actually detail specifically what I'm talking about with this volatility box because, well, it's imperative to the coming trading sessions. First of all, we're actually going to back out here in the S&Ps, to a slightly longer time frame. This is 9-month daily. Now, for those of you that might be a little bit newer here, maybe you've not necessarily tuned into a lot of TheoTrade videos, we're looking at the S&P futures. Why do we look at the S&P futures? Because they drive order flow, to the rest of the marketplace. Effectively, what I'm saying is what the S&P futures do, so goes the rest of the market. And I know that very often we look at underlyings like, Apple, and you try to assess where Apple's going to go very much autonomously. But if the volatility kind of picks up, and that's exactly what we're talking about today, and if that volatility picks up, I mean, people, listen, that's going to drive everything on your screen. So as we come into the cash close, you can see some sell side activity in here. All right. And again, there's the closing bell. This is literally answering this question. Are we back in this volatility kind of box? What's also sometimes termed a volatility channel. In past years, I've even called it and dubbed it, the AKA the hurt locker. All right. Back just over a month ago, in the entire month of August, we were actually trapped inside of a fairly extreme volatility box. These volatility boxes, they occur time and time again, but they're everything in terms of trade, because what the volatility box effectively does is look at some of the ranges on a day-to-day basis, and I can't stress this enough. Inside the volatility box, the intraday ranges become nothing less than phenomenal. I mean, you see, again, here's a perfect point to be made. You're looking at 70-point plus moves inside of the S&P futures, and it's happening again, time and time and time again. So you have to expect that if we're back inside of the volatility box, and again, I'm going to try to answer that here momentarily, that you're going to get aggressive, wild ranges bouncing back and forth. Stuff, that traders, especially traders that use in-out spreads, are going to love. Think about that for a second, because markets with these wild ranges that are completely and feel unpredictable, you put on a trade one day, you're a zero. The next day, you're like, wow, I just took that one off profitable. And that's the kind of trade that, again, we live for. Now, the previous volatility box, which, again, I'm going to just give you my opinion right now. I do believe we've now dropped back inside of it. But that previous volatility box, it ran, and I'm going to kind of detail this on the screen right now, right from this neighborhood here. Now, when I say that neighborhood there, that happens to be none other than 2940 in the S&P futures. Now that level, I don't want to put that as definitive. That's not something like one of these gravity points. So don't confuse it. All right, it's just the upper level, again, of what has become a volatility box, where we picked up over there, and the next thing you know, you're down to the bottom of it. The bottom of it is somewhere right around 2820. We sat inside that vol box for a full month, and I'll tell you what, the acceleration of moves from the top of it to the bottom of it, as I said a moment ago, we're nothing less than awe-inspiring, phenomenal. And the moves back up were equally as impressive. Now, if you've never seen one of these volatility boxes, this is not the only one, in recent times. Let's actually pull up a 3-year chart for just a moment, You've actually got, these signature volatility boxes again and again. Here we are back in 2018, but probably the most notable one, the most notable volatility box that we've been trapped in recent history is undoubtedly, in October, November, and the beginning of December, of 2018, where we were just punching back and forth from 28, 20-ish all the way down to about 26.30. That doesn't look like that much on the screen. And again, I just got to highlight this. I know that doesn't look like a whole lot on the screen. These are massive moves. Massive moves. Again, you're talking like 200-point ranges. Okay, some of the volatility boxes we've seen lately have been, well, tighter, and we believe we're starting to drop back into that. And again, you get this pinging back and forth. So what else adds to this kind of logic? Well, first of all, okay, just today's trading session. Today's trading session is perfect. It's hallmark. It's indicative of it, right? I just said, well, hey, listen, there's an expansive range over there. Great, 30-point range, 30-plus point range in the S&Ps. Okay, well, that looks a lot like what we've seen in some of the previous volatility boxes here, both to the upside and to the downside. What else can actually add to this kind of logic? Well, let me actually cruise over from the S&Ps, all right, and jump right to the volatility futures. Now, one of the things that really stands out to me in the volatility futures, just bottom line. Listen, the markets are not exactly getting like rocked right now, right? I mean, come on, we're trading 29.37. If you haven't looked lately, we're still a stone's throw off the all-time high. But you wouldn't know it. Like if you look at the volatility markets, both the VIX and you look at volatility futures, like they're, again, edgy right now. What are they edgy for? I don't know. You could name 50 different issues, okay, on the very near-term horizon. But there's one thing that really stands out with these volatility futures, and this just ain't normal, okay? What's not normal in the volatility futures is that we still remain and bouncing back and forth, okay, from a vol skew that's completely and utterly flat to full-blown like backwardation. What I'm talking about with like backwardation is the 44-day volatility futures are trading at 1880. Then the 72-day volatility futures are trading at 1870. Now, you know, there's a couple of risks obviously on the horizon. Pick your risk. You want to talk about China? Great. You want to talk about impeachment proceedings? Don't want to hear it anymore about the politics, but great. I mean, again, you want to talk about, again, military threats, geopolitical. I can go on and on and on, literally all day about, you know, all the risks out there. But one thing is very, very apparent, and that is if you look, again, 44 days out versus, for example, 72 days out versus, for example, 107 days out, the volatility is relatively flat. The crazy thing is in 44 days from now, the vol is actually slightly higher than it is 72 days from now. And then 100, and then again, 107 days, it picks up ever so slightly again. But there is a very mild, okay, what we term backwardation. And what that says is that the risk, okay, in 44 days is actually higher than the risk 72 days from now, which is the market seeing something right here, right now, that's carrying its risk to be higher than it is 72 days out. Could it be the Fed? Right? Again, I said I can go all day with all the different, you know, I guess ideas behind why that risk is higher. But yeah, a lot of it has to do with the fact the market seems to be anticipating a lot of volatility over here. Now, I could also point out, if you look at the VVIX, that's the volatility of the volatility index, okay? And I've just been rehashing this day in and day out. Look, the VVIX, which is indicative of traders hedging, that thing is still clear north of 95, okay? You can't point out any other time since this product, okay, has basically since the inception of the VVIX, you can't point out a time, okay, where the vol of the vol has been sustained this high for this long with markets at or near all-time highs. It just doesn't happen. Okay, again, it's unprecedented to actually see volatility of the VIX itself this high, which is, again, it's just indicative. It doesn't mean the market's going to take. It's just indicative, though, of trade doesn't see, okay, market like fear collapsing. They're keeping it, you know, up. They're keeping, like, again, intensity in this marketplace kind of high. I'm going to show you some other stuff that's really kind of bothersome. Again, this is just for the remainder of the week. Bear with me for a second. Pull up the SPX, the mother of all products. Well, the mother of all products has a pretty expansive expected move, okay? But as we actually pull up the SPX, and you always want to get a read, like, you know, you can ascertain quite a bit from looking at the charts, okay? But you always want to get a read specifically on the option chains themselves. And the option chain itself, it's still portraying a $47 expected move. Again, a $47 expected move just between now Okay, and the expiration this Friday. I point that out because the markets moved a decent amount today, and yet they pumped up a little bit more volatility into the SPX. All right, so that's for the remainder of this week. You know what's also for the remainder of this week? If you take a look at the financials, the XLF, there's almost 54 cents of expected move packed into here. Listen, that's just for the next 4 trading days, so put your helmets on because the financials, yeah, that moves markets. That absolutely moves markets. So everything thus far that we look to, whether we're looking at the S&Ps, whether we're looking at the SPX, whether we're looking at the VVIX, whether I'm looking at the Volatility Futures, I'm looking at the XLF, again, all of it point to the fact that we're back inside of this volatility box. I got one more that's just completely perplexing that I want to leave you with, okay? And that has everything to do with the bonds. Bonds. All right, we haven't had a down day in bonds in, well, a long time. You know, your 3 weeks of trading, you get one down day like every 3 weeks inside of the bonds. But the curious part today, okay, and I'm not sure everybody necessarily picked up on this, all right, those bonds, they're down. They're down 25 ticks, almost a full point. And yet the financials are down 0.5% with it. Now that's something, people, we just haven't seen a lot of lately. As the bonds have been back on what we term the bid, they're buying them. Okay, as they've been buying those bonds, what have they been doing to the financials? They've been just decimating them, alongside a couple of bounces back to the upside. But it does appear that the financials are currently in trouble and could very well see 2650 once again in the very near future. Okay, net, what are we looking at in the next couple of days? Volatility. It felt quiet today. The marketplace kind of crept up on us a little bit. In terms of liquidity, you know, the S&Ps, they only did 1.2 million contracts. That's not exactly like blistering size inside of the S&Ps. Nevertheless, it does appear that we are, in fact, back inside the volatility box. So we're going to expect what? Well, some fast moves to the downside, some ripping rebounds over here, the kind of stuff, okay, that traders absolutely love. Thanks, everybody, again, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.